Let's start with some good questions, I think. The first one I have is for Martha, and we've noticed a big growth in your faith-based business, especially in the last year. What do you think's driving it?
Yeah, make sure people can hear me.
We can hear you.
I'd point to two things. One is really just the interest in growth and passive investing in general. I had to look up some statistics for this. I didn't know it off the top of my head, but in 2007, about 20% of mutual funds and ETFs were invested in a passive manner, so they weren't actively managed. 10 years later, they're close to 45%, and this is in the US. Similar trends abroad, so passive investing has really seen a huge pickup in interest from investors. So I definitely point to that. But two, I really think is our approach. So again, the fact that we don't try to impose our values on clients. We don't say, hey, we've got a Catholic values product for you. Instead, the conversation starts the other way around. What's important to you? Tell us what you'd like to achieve through your portfolio. We work with a lot of advisors, and these advisors often come to us and they say, gosh, like, how come you guys have seen so much success in responsible investing? I can't get my clients to. So we ask them, well, how are you starting the conversation? And they're starting the conversation with kind of their values and their products instead of starting the conversation with, well, what's important to the client? So I really think it's that understanding the client goals piece that's really helped us out a lot.
Great feedback. I think that's a key, is understanding the client and their view on all of this. So Dwayne, since you might have a smaller group of securities that you're following, tell us something about challenges in the healthcare space and maybe some areas where you think there's a promise for Catholic investors.
So probably the most challenging sector. So all of Dana's portfolios are sector neutral. So we're going to match the market weight in healthcare. We're going to match the market weight in energy. And in a Catholic portfolio with the sanctity of life issues of the USCCB guidelines, that becomes a challenge, particularly in the large cap space. Pretty much at this point, every large pharmaceutical company is excluded because they produce an abortifacient or a contraceptive. The challenge, one of the things I didn't mention is that our Catholic strategy has actually outperformed our unconstrained flagship strategy. So we actually believe the ESG integration helps performance because we've seen it over an 18-year parallel track record. Part of the outperformance of the Catholic strategy has come from the healthcare sector because the restrictions have forced us to go lower down into the market cap spectrum to find these niche pharmaceutical players that don't run afoul of some of the restrictions that we're trying to abide by. So there are opportunities that come with that, but there are risks and challenges. And unfortunately, the challenges become greater every year. As I said, we saw some of our performance enhancement actually come from success in mid-cap pharmas. Well, it's becoming harder and harder to find mid-cap pharmaceutical names that we can use in our Catholic portfolios for two reasons. One reason is that there's been a lot of M&A in this area. The big pharma companies keep buying smaller pharma companies because they're buying the research, they're buying the development costs. So rather than do R&D internally, they wait for a smaller company to do some of that R&D, and then they buy it when they are approaching marketable stages. So there are fewer and fewer mid-cap companies. The other issue that's come into play, and Sam, you talked about this earlier today, is just the issues with stem cell research. So there's a stem cell line, for example, a human embryonic stem cell line that was harvested, is the term used, in 1973 in the Netherlands. And it's become ubiquitous. It's used in research almost in any kind of biological science environment at this point. And so there are few companies, even in the small and mid-cap area, there are fewer and fewer companies that don't have some connection to human embryonic stem cell research. So it's becoming more and more of a challenge. There are some. One of the issues, I think now, we also have the financial challenges. So there's a company, for example, that we've been monitoring recently that's doing some great stuff in terms of addressing muscular dystrophy. and it's a biotech company that's doing some great research, very promising results. But if you look at the biotech space right now, most companies don't make any money. And we're a value-oriented investor. It's hard to invest in companies that don't make money when you're a value-oriented investor. So this company doesn't make money yet, but they're very close to it. Should they become profitable, I think it's something that we could add to the portfolio. But that's the big challenge. We continue to be sector neutral. We emphasize things in the medical devices space a little more than the drug area, but we try to find the drug exposures. Hospitals are a problem, so we emphasize other services like the LabCorps and other things that when they can pass the screening. So it's a big challenge, but we remain sector neutral, and as I said, historically it's actually been a source of excess return.
Great, thank you. Tell me a little bit about where investors thinking about Gunner, where does it fit? Is it, for you, is it an equity investment? Is it a diversifier? Is it ESG? Where would you plug it in the model?
Yep, I mean, it really goes to our whole suite of real asset type products. We look at it as a hedge of inflation. One of the biggest challenges for a lot of investors, whether you're private investors, whether you're looking at running liability-driven investing, is keeping pace with inflation and the higher cost of living. We have chosen to, whether Gunner, our infrastructure, and our real estate product, own equity-oriented solutions, simply because for most investors, it's a dramatically more efficient way to get exposure to those asset classes. The benefits of using futures-oriented products have really diminished pretty significantly. So for most portfolios, again, we'd probably be finding anywhere from that 5 to 10% allocation. These day and age, majority of those assets are funded on the equity sleeve, so we would definitely consider those equity investments. But you would get global diversification across really those categories of infrastructure, natural resources, and real estate.
Great, thanks. So just so everyone knows how to access these fine folks, I'm going to ask them, Martha, I'm an institution out here or advisor, and I'm thinking Parametric is where I want to be. What do I do? How do I get started?
Give us a call. That would be great.
Okay.
Specifically not me. We have a great sales team. I'll just probably butcher it if you call me. But we have a great sales team. We're global in nature, so there's sure to be someone in your neighborhood. I will just say, the one thing we're not trying to be is an advisor. So we like to work with advisors, consultants, institutions that have their own investment teams. What we're not trying to do is step in and tell a client how to invest their money. So we're just an asset manager in that sense. So I did get a question earlier today. Do you work directly with retail? We work directly with retail if they have an advisor in the middle.
And we noticed that they're available on platforms like if you have an account at Schwab, you could work with Parametric. What about you, Dwayne? How does someone work with you guys?
So for most of our assets are large institutions who deal directly with Dana, and we're happy to have those conversations. One of my colleagues, Bob Gray, is sitting in the audience. He would be happy to talk to anyone from that perspective. But we are available through the advisory channel in a couple different ways. Through platforms, the Folio platforms or InvestNet, and then through a couple of trust banks, including Northern Trust. Our ASG products are available through Northern Trust. It's a pretty broad array, and like Martha, I'm going to defer to our sales and marketing team, who can answer the specific details much better than I can. But there are multiple institutions can deal with us directly, but we have a lot of certainly the greater number of clients who come to us via relationships, platform relationships.
Good answer. Gunner, how do they buy it?
Yeah, whether it's, we have a family of ETFs, exchange traded funds. If you can buy a stock, you can buy an ETF, you can buy a flex share. So we're available there. Broader Northern Trust can build custom solutions, whether it's collective investment trust, whether it's really customized solutions for you. Typically, those are dramatically different levels. Probably most importantly, we have a number of firm partnerships, such as your own, where we are building blocks. So we are blocks you can use, like going to a Home Depot and buying what you need to build a house. Whether you're doing it yourself, whether you're looking at financial partners, we are building blocks that are available pretty much everywhere.
So we have a very short amount of time. Normally we go a question on each one, but I'm going to throw out just a wild card. And if anybody wants to answer it, they can. And if everyone wants to run off, that's okay too. So we're at a very end of a, well, I don't know, end's not the right word, but we're in a very long bull market. Probably a lot of you out there have a lot more money than you did before if you had it in equities, and that's good. But a lot of people that we talk to are kind of concerned about that and the market in general. Does anyone want to take a stab at kind of that question, or do you think we're at the end? Do you think this is another 10 years of great times, or does anyone have an answer on that?
I'll jump in, and this is more the thinking abroad in Northern Trust. We are biased towards risk assets versus particularly domestic versus international. We think you need to have your right asset allocation. You really need to understand what you own. We're probably a little bit biased right now towards either quality or value oriented factor products relative to some of the higher priced parts of the market. But get your diversification right. We do think the U.S. is in very good shape from a corporate earnings standpoint. It's kind of the prettiest house, but we come up with 5-year capital market assumptions across almost all core asset classes. Our capital market assumptions are probably dramatically lower than most people's expectations of what the market can do. You can't look to the past to look at the returns we're likely to get going forward.
Great answer. Do we have time for one more, or we? Well, I think we've reached the end of our equity presentation. We really appreciate all of you giving your expertise on the subject. One of the things I wanted to mention, because we're kind of in the more of the product area, on our website, IWP Capital, all of the partners listed here, they all have a section on the site. So if you're trying to remember, how did I get to that Dana website? How did I get to whatever you're looking for, you can come to IWP as a start, and you can fan out wherever you need to go and find the right people, and they can answer the questions you have. So anyway, thank you very much.
Thank you.